Hello and welcome. Today, we're going to pull back the curtain on the world of finance. We're going on a journey to see how a stock is born, where it lives, and how we track its every move.
You've heard it a million times on the news, right? The market is up, the market is down. But what in the world is the market? Is it a physical place? Some giant computer somewhere? That's exactly what we're going to figure out.
So, to really get our heads around it, we have to start with the most basic question of all. Why do these markets even exist in the first place? What's their purpose? At its heart, a financial market is basically a massive matchmaking service, but for money. It's all about connecting people who need cash, say a company that wants to build a new factory, with people who have extra cash and want to invest it. The whole point is to get that money to the places where it can do the most good, where it can be the most productive. And that, in a nutshell, is what fuels the economy. Okay, so that covers the why. Now let's get into the what. When we talk about the stock market, we're really talking about little pieces of companies. But where do they come from? Let's witness the birth of a stock. Every stock story starts right here, in what's called the primary market. This is its big debut. When a private company decides it wants to sell shares to you, me, and everyone else for the very first time, that's called an initial public offering, or IPO. And this is the only time the company itself actually pockets the cash from selling its stock. But a company can't just wake up one day and say, hey, we're public now. It's an incredibly complicated process. They need a guide, a kind of Sherpa, to navigate the whole thing. And that expert guide is the investment banker. The investment bank really does three huge things here. First, they're the advisors, helping the company figure out when to sell, what price to ask, all that good stuff. Then comes the really critical part. Underwriting. This is where the bank actually buys all the new shares from the company, taking on the massive risk of selling them. And finally, they become the marketing and sales team, hitting the road to get investors excited and actually sell those new shares. All right, so the stock is officially born. The company has its money, but the stock story is just getting started. Now it needs a place to live, a place where all those new owners can buy and sell it from each other day in and day out. And that new home is the secondary market. This is the market everyone's talking about on TV. If the primary market is like a new car dealership, where a car gets sold for the very first time, then the secondary market is like the entire planet's used car market, where those cars get bought and sold between different drivers over and over again. Now, this secondary market isn't just one single thing. It really comes in two main flavors. On one hand, you have auction markets, like the New York Stock Exchange you see in movies. Think of an actual physical floor where brokers battle it out. Then you have dealer markets, like the NASDAQ. There's no central floor there. It's a huge, decentralized network of computers and dealers all connected electronically. Here's a really simple way to remember it. The NYSE is like one giant auction house where everybody comes to bid. The NASDAQ is more like a giant digital network of competing shops, all showing you their prices online. And hey, for those stocks that aren't listed on the big name exchanges like the NYSE or NASDAQ, there's another place they can trade. It's called the over-the-counter, or OTC market, which is basically another dealer network for these kinds of securities. So, we have millions and millions of trades happening every single second across all these different markets. It is physically impossible to keep track of it all. So, how do we get a quick read on how the day's going? How do we keep score? We use what are called market indicators, but you probably know them as indices. An index is really just a simple tool that gives us a broad overview of what the market's doing. Think of it like taking the market's temperature or checking its pulse. Let's start with the most famous one, the Dow Jones Industrial Average. You hear that name and you think it must be tracking hundreds of companies, right? Well, it actually tracks the performance of just 30. That's it. 30 of the biggest, most established blue-chip companies in America. Now, if 30 sounds a little too small to represent the whole economy, you'd be right. That's why we have a much broader measure, the S&P 500. And yep, you guessed it, this one tracks a basket of 500 of the largest U.S. companies, giving us a much wider lens on the market's health. But the biggest difference isn't just the number of stocks, it's how they're calculated. The Dow is what we call price-weighted. That means a stock with a high share price has more influence, even if it's not a huge company. The S&P 500, on the other hand, is value-weighted. It cares about the total size or market value of the company. That's why the S&P is often seen as a better reflection of the overall economy. Okay, let's zoom out for a second. It's so easy to get laser-focused on US stocks, but we have to remember the financial world is this massive, interconnected global system. Take a look at this. As absolutely huge as the US market is, it only makes up about 1/3 of the world's total stock market value. That means there's a whole 2/3 of the world's investment opportunities outside of US borders. And of course, the financial world isn't just about stocks. There are gigantic bond markets, which mostly trade over the counter. You've got dozens of other major stock markets all around the globe, and then you have emerging markets, which offer incredible growth potential, but, they can also come with higher risks. The one thing we know for sure is that markets are always changing. They've already gone from rooms full of people yelling to global networks powered by algorithms. It's been an incredible evolution. And that leaves us with one final, really interesting question to think about. As technology makes everything faster, cheaper, and more connected than ever before, what will the marketplace of the future even look like?